Welcome to this week's Armchair Trader podcast. We're going to be talking a little bit more about the technical side of things this week, and to discuss that with us, we have Trevor Neil, who's a director at RRG Research. So welcome to the podcast, Trevor.
Thank you very much for having me.
So I think really to start off with, we should sort of set the scene. We're here really to talk about something called relative rotational graphs, and it might be best if you just explain to listeners first what these are and who RRG Research is.
Relative rotation graphs and relativerotationgraphs.com was formed about 10 years ago, but the original work for this was done by a colleague of mine, co-director at RRG Research Limited, called Julius de Kempenaar. He's definitely the brainy one of the two of us. We've known each other for more than 30 years, never actually worked together except in this project here. He was on the sell side at an investment bank. I've been in fund management. We're both friends through technical analysis. And he had been trying to solve a problem for when he talked to customers, and his customers were funds, hedge funds, buy-side people, and working on the sell side. So he wanted to sort of draw their attention to a simple way of seeing a picture that covers lots of information, lots of graphs in one graph, and so very clearly shows relationships between securities and clearly shows you opportunities. So we developed this into a mathematical visualization, which is a quadrant. I'll talk about that in a second. And then this went on to Bloomberg in the year 2000 as a function on Bloomberg, RRG Go, if you have access to that. Then later on onto Icon, and very popular with clients of that professional platform, people who have to choose securities from a group, from a universe, in order to, for example, achieve outperformance of an index. And so it's a very adaptable tool, but it allows you to see lots of securities normalized, relating to each other, and the opportunities of the securities in your universe.
So it's basically a way of just cutting through a lot of the noise in the market. If you're an investor or a trader and you're looking at an index or a basket of stocks, and you really want to find the ones that are likely to be the real sort of outperformers going forwards.
Yes, that's right. I think it's more than the noise. It's trying to see them all together. So you have a universe that, let us say it's the Nasdaq or something like that, and you want to see all the 100 stocks compared to each other and which one is better than that one, and relating to every single one. And if you wanted to do that the long way or the normal way, to take 100 stocks and compare each one with each one, is many thousands of comparisons, and then to say, well, this is better than that one is very, very difficult to do. But here you have one picture of a scattergram, a dynamic scattergram, which makes it obvious instantly how they relate to each other and how they're moving. So this is the attraction to it, really, is it cuts a work process of finding the selection by the criteria of relative strength and momentum of relative strength into a very quick piece of analysis.
You could use this with any of the main sort of market stock indices, or potentially you could put together a whole, if let's say you're looking at a sector, you could pick, there's a big sector, 50 stocks within a particular sector that you've built that list yourself, and then you can apply this criteria to analyze the stocks that way.
Absolutely right. That's how people use it. So on your Bloomberg, for example, you can put as your benchmark whatever you like. The benchmark could be a stock index, it could be the MSCI World, and you might have assets, comparing all the assets, cash, gold, US stocks, emerging market stocks, government bonds, and so forth, comparing each to each versus the benchmark being the MSCI World. You could use the S&P 500, you could use versus the GICS level 1 sectors. You can see IT and industrials and so forth, how they're relating to each other and how they're moving in relation to each other. That's what's unique about the chart, is it is dynamic. Or you could say, well, I like that like I never used to like energy. I hated energy, but now energy is come up a lot, and technology has gone down. Let's look at energy, and then I put energy in the middle of it as a benchmark, and then look at the industries of energy, and then go down, drill down from the industry. Let's say it's oil development is the leader. Then you might drill down what are the names of the stocks in that group, and then compare those and find literally from the top, if you like, from the best asset class in the world. Let's say the answer is US stocks. The best sector in the US, let's say it's energy. The best industry, let's say so-and-so, the best stock, let's say. So you've drilled down from asset all the way through, is really what you said. But it can be used for other things too. Anything where you compare a group of things to something which makes sense. So another one could be the US dollar and cryptocurrencies. So the cryptocurrencies, the major cryptocurrencies, which is the best, and which is, are you better in the dollar or in which particular cryptocurrency? Or it could be commodities, futures versus the Russell Commodities Index, for example. And you could look at that. Anything which makes sense to put together as a group, and then you've got a choice of how you go into that group and what level of risk you want to take, because what it will show you very clearly is what is the strongest. Well, that's easy for anybody to see what is the strongest, but it's what we've introduced, and this is the technical analysis aspect of it, is also the momentum of the relative strength.
So that's interesting. It's not just restricted to equities. You could use it, as you said, you could use it for cryptocurrencies as well. It's not just relying on share market data.
Absolutely right. It's anything where you've got something which is a benchmark, and you've got choices to make regarding how you try and outperform, for example, that benchmark.
And this has obviously been around for quite some time, and it's being used by fund managers and other people in the market. I know you probably can't name names, but do you have any examples of sort of the most widely used purposes?
We know from Bloomberg that it's a very popular function. They don't tell us who uses it. But then we are engaged as consultants to a number of groups. But you can see, if you go onto the State Street website, they use relative rotation graph to show their own ETFs versus the S&P. So so basically it's allowing you to choose what you think is the best, and it's so easy to, once you see it, to visualize what is the best according to your own criteria, using the relative rotation graphs. And so they show their own funds, how they relate to each other, to help people make decisions amongst their own universe. But we work mostly directly with hedge funds who have got their own benchmarks and their constituents and criteria and constraints in their mandates. And so we design the universe around that and the criteria around it. And it may involve other overlays like the market cap of the securities, and there may be other criteria to do with fundamental research, but we can filter that and then make that the universe, and then do the final level of analysis using RRG.
And obviously, listeners will be thinking, "Well, this is fantastic, but how can I get access to some of the benefits of this sort of intelligence?" I know you've been doing some work with CMC Markets, which is a name a lot of investors in places like the UK and Australia will be familiar with, and you've been supporting them with the launch of some index products they've got going there. Can you tell us a little bit more about that?
Yes, Julius and I work a lot with funds and fund managers and big traders, family offices, helping them design these effectively internal products. But we're very thrilled, really thrilled to have the opportunity of offering this method, an institutional method, to the investing public through CMC's contracts for different CFDs. So we designed a criteria which we think is a good one for this particular marketplace, and then we've applied the same criteria, quantitative criteria, the same conditions for the RRG to give a signal in a number of different instruments. And we started off with the launch in October of the UK 350, and that went well and was popular and did its job, which was to select stocks which were better than the index itself and hold those stocks. And then just now, at the moment, we're releasing a whole new, or they have just released a whole new set, the S&P 500, the NASDAQ 100, Australia 200, US Growth 1000, so this is growth stocks, the Hong Kong Large Cap, and the Germany 110. The reason we don't use, for example, the DAX is because the universe itself is too limited. So we have to broaden it out so we can get some outperformance by choosing the best ones in it. But so 30 would be too small numbers, likewise with the Dow. So we want these broader indices so we can choose. The criteria that we use is the following. There are 3 sweeps in the criteria. Now, the first thing is that every security that's included is going up. Okay, so we use technical analysis to define that. The second sweep is securities which are heading northeast in the quadrant of the RRG. So now what does this mean? The x-axis of the RRG is the relative performance. Things to the right are outperforming the index. Let's take the example of the S&P for a moment. So we've got the S&P as the index, then we'll have a scattergram of the securities in the S&P, and the ones that are furthest to the right as the strongest stocks, and the ones that are furthest to the left are the weakest stocks relative to the index. But then we have a horizontal axis, and everything that's above 100 in that is with relative positive momentum in the relative performance. So what we're saying is that anything which is in the top right-hand quadrant has got outperformance and positive momentum of outperformance. Anything in the bottom right-hand quadrant is outperforming but losing positive momentum in the relative performance. Bottom left is the horrible place you don't want to be. These are securities which are underperforming with no positive momentum. And for an aggressive trader, the top left-hand quadrant would be interesting. So these are securities which are currently underperforming, but have got positive momentum in their relative performance. So these are things which are coming up the list of performance, but from a low reading. So these are the things which are going to give you outperformance, in fact. So we plot a tail of where the security is in the scattergram and where it was, say, last week, the week before, the week before, the week before, and you get a rotation pattern because securities rotate around this quadrant pattern. Actually, the rotation is clockwise. The securities will generally go around this in a clockwise direction. So, but the best direction for it to be going in is northeasterly, so between 0 and 90 degrees. That means if it's moving easterly, it's increasing in outperformance, and northerly with positive momentum. So the first scan was to look for stocks that are going up. The second scan is to look for stocks which are heading northeast on RRG. So their relative performance is increasing and the momentum of relative performance is increasing. It's likely to go further is the inference of that. And we do see the persistence of that. And then when we've got that list, and I can tell you currently in the S&P, there are 227 securities out of 500 which meet that criteria. Then we take the 10, just the 10 that are most to the right. So most to the right, the ones which have got the highest outperformance. And that is our portfolio. And that is rebalanced every quarter. And that exactly what I've said there is the same for the NASDAQ, is the same for Australia, is the same for Germany. We're looking for securities which are going up, which have got positive relative performance and positive momentum of relative performance, and they're the 10 best of that group. So you have a portfolio representing an index like the S&P or the NASDAQ, but selecting just 10 stocks with all those 3 characteristics. And it relies on the fact that this tends to be persistent. Good stocks tend to be the good stocks for a long period of time. You know, Apple was a great stock for a long time, maybe not so much now. Tesla was a great stock for a long time, not so much now. We hated energy, but now we like it again. But the hating of energy as a sector was a long, multi-months, multi-year. So these things tend to persist. And so we pick up on these things, we build the portfolio to a maximum of 10, and that's what we, the 10 that meet this criteria, these three criteria, best of all.
When you say you rebalance every 3 months, how many of those 10 would you tend to drop? Is it quite fundamental, or are you only really changing a couple?
Because it's 10, it does tend to change. But it is amazing how in the top 10, you know, out of 500, according to this criteria, that the same one would ever stay there. But of course, because of the persistency, it does happen. And so quarter by quarter, it's still in it. But because it's only 10, the best is probably going to be better. It's not, the ones that have dropped out are not really terrible, but they're not in the top 10.
Gotcha. And just going a little bit back to, you mentioned that this has been available for some time. This is sort of an original creation of RRG, and you guys are the ones who developed the sort of fundamentals underlying this. What can you give us a little bit of background on how you guys stumbled across this? What was it that made you realize that you could analyze stocks in this way and provide data that you know, fund managers could actually act on?
I must give most of the credit to Julius. I mean, he spent his last 30 years doing only this. So I've been doing other things, running a fund, for example, as well. What it started off with was to solve a problem. Julius was on the sales side of the business. I was on the buy side of the business. I was a fund manager, but both of us were technical analysts, and we talked about this, solving this problem. It's so complicated to look at so many securities and in some way normalize them in such a way that you can literally compare anyone to anyone in one picture. This is the wonderful thing about this. It's one immediate, obvious picture with dots on it that have got tails on, and you see how the thing is, the individual participants are relating to the index that you've chosen, and with the software you can put whatever is relevant to you, even your own benchmark that you've designed yourself, and that you're required to work to as the benchmark, and choose your securities, whatever is appropriate to you. So we both understand technical analysis. We both understand relative strength. So relative strength is very simply a stock divided by the index. So we can do that and turn the answer into percentage. The thing with the highest percentage is the strongest stock. The one with the lowest percentage is the weakest stock. So there you've got a static picture of best to worst. But that list is dynamic. And it is things coming up through the list which are the most interesting things, and things which are going faster up through the list, increasing in momentum. Also, as technical analysts, we understood that momentum, the rate of change of speed, is an early indicator of changes in direction. So let me explain that. If you think of if you throw a tennis ball into the air, for example, and you had a high-speed camera and you observed the tennis ball as it approached the top, you could see it was going up, but slowing up, gradually slowing up as it approached the 1 nanosecond top, and then it will accelerate out of the top and then accelerate in the fall. Now, it was still going up, but it was slowing up. So the slowing up always precedes the turn, and then the speeding up comes after the turn. So when you plot the relative performance of something versus an index, and you see it's going up, but then you plot also the momentum of it, you would expect the momentum to turn down just before the relative performance turns down. So you get this early warning. And that's what turns the securities from the top right-hand quadrant into the bottom right-hand quadrant, because it's got outperformance, but it's losing momentum. So what side are you of the tennis ball? Going up. The tennis ball is going up and getting faster. You're in the top right-hand quadrant. Starting to slow up, you are in the bottom right-hand corner. Going down and accelerating, bottom left-hand quadrant.
That's very interesting. So could you, for example, take, let's say you already own a stock. Could you stick that into a universe? I mean, I presume you would need to be able to compare it with other shares, but you would be, if you stuck it into a universe of peers, say defined by sector or market cap or something like that, you'd be able to see, is this share starting to lose momentum now? I mean, for example, there are lots and lots of people in Tesla at the moment. Some people may be thinking, wow, maybe I should be starting to get out of Tesla. There's a lot of negative price activity there, but is it really losing momentum? That's an interesting question.
Let's leave Tesla to a side for a moment. Don't forget it is 30% down from the high. So I think we could say it's not going up anymore, depending on your point of view, of course. But the answer is yes about that, because a lot of fund managers, their criteria for picking securities is fundamental. They're doing their research, they're looking at their spreadsheets, they're looking at the finances, and they choose the portfolio accordingly. But one of the things they will do, if they're wise, and many of them do, is, let's say they've made a decision about a security on the basis of its fundamentals, but then how does it fit in the universe of other closely related securities or other securities that meet their criteria that they haven't had the time to do all the work on? And they might say, well, here's two securities which are almost the same as each other, say two US car companies, for example, very closely related to each other. I've done all my work on Ford, but then I see the General Motors actually has got better outperformance and higher momentum. That might change their mind about their decision to want to get into US automobiles. And so they do use that as a tool to help them make their decision, which ultimately is made on a fundamental basis. But that's indeed a great use for it. But, in the case of Tesla, for example, in the S&P 500, Tesla was there on our list on there until it quite rapidly lost upside momentum before the market itself flattened out and dropped out of the list. It's now on the bottom left.
You mentioned before the DAX was almost too small a constituent for doing analysis like this. What would you say is the minimum sort of number of stocks to provide an effective graph?
I would say 100.
Right. Okay.
I mean, we've made that a decision. By the way, that is our decision. 100.
And are there any sort of market scenarios or any sort of macro situations where you find the analysis doesn't work as well, or particular sectors or something like that?
Yes, it's not that it will work well in anything that it's designed for. So looking at things which are related to each other, it works. When you look at it, you will see what you see. But there are things which don't make any sense to do. Now, something like, and people I've seen have done this, they look at a universe of ETFs, say, versus the MSCI World. But some of the ETFs are denominated in dollars, and some are in euros, and some are in pounds. So now you've introduced currency risk into it, and you've not accounted for that. So some of the strengths of the ETF is actually the strengths of the currency versus the dollar. And so that simply doesn't make sense. You have to compare apples and apples, not apples versus oranges. Markets with different opens and closes as well, it doesn't make sense. You really want them to be in the same time zone, because you're taking reading in one time zone and then reading in another. That doesn't make sense. But principally, things that don't relate to each other. There's no reason for them to relate to the benchmark that you've chosen. There has to be. So if you took, for example, US automobile stocks versus the DAX, for example. I mean, and maybe the DAX is a bad example because it's got a lot of automobile in it. But if you took it, say, versus some minor stock index because you happen to live there, but the two things are not connected in any way at all, and they're probably different currencies as well. So it's basically common sense what doesn't work. But anything which is comparable, and comparable must mean it will be in the same currency, and it's related, and the benchmark is a benchmark of that of some sort, then it will make sense. So that's the limitation. It's not that there's anything it works better in. I mean, it'll always show you the relationship. It's only a picture. It's like saying is charting better for commodities or equities? Well, it's better for both. It's just showing you the picture of what is going on.
Right. So even if you were building, say, a thematic index, you would have to be aware of that. You can't just stick oil companies and oil futures in the same scenario analysis. You've got to really ensure that everything is effectively playing on the same playing field.
That's actually a very interesting question, because it's a problem for us right now, because in the next stage we're hoping that we're going to add more, as long as this group that we've got now is as successful as the FTSE 350 was, then they've asked us to work also with thematic ones. Now, let's say if you take electric cars, for example. Problem number one is that electric cars, the big electric car companies, are in different currencies, are in Europe as well as the US. So we have got to normalize that in some way. The second thing is what's the benchmark? So what we've decided there is, if there's a leading benchmark of the theme, we'll use that as our benchmark. So we'll say we are trying to outperform that ETF, which you can buy, which represents ESG, for example, and we are here to find these constituents that make that up, that are, as long as we can get 100 of them, that have got relative outperformance and momentum of the outperformance, and also in an uptrend. Pass of three filters through, but we have to use an ETF as the benchmark, because there is no real benchmark to use.
Right, yeah, and as we know, there's more and more of these thematic ETFs coming onto the market. So
yes,
you may be spoiled for choice there.
Yeah, we have got one released now, which is US growth, and we're using an ETF of growth stocks as our benchmark. So our aim is to do better than that.
Obviously, it strikes me as an excellent way, this project you're working on with CMC, for investors who are not so familiar or not so comfortable with technical analysis, to actually get a lot of the benefit from the science of technical analysis. And it's something that some people, when they first get into active trading or active investing, find quite intimidating, because a lot of the trading platforms will present them with a vast range of choices in terms of the graphs they can apply. And it quite frequently, I think, turns some people off. I wondered, from your perspective, as someone who's been working in technical analysis for a very long time, for someone who's just getting started in trading, when they're presented with this long menu of various graphs they can use, what would you say are the ones, for the basic ones that a beginner can really get the most utility out of before they go too far down the road, looking at Fibonacci and things like that?
It's a good question, but let me just first of all make it clear that when we're talking about RRG, we're looking at a choice of opportunities. So we're not looking at the absolute value of any stock in the individual security itself. We're looking at its performance versus an index. So we're looking to get outperformance of that index. It's possible that we can get outperformance with the stock itself going down. So we're not looking at the chart of the stock. We're looking at the chart of the stock versus everything else in the index. So that's different type of technical analysis, but still very simple, conventional. I can tell you, I'm not going to tell you what it is, but it's there's nothing magical about it. It's just we put it together in a particular way. But to answer your question about getting into technical analysis for first time, you're right. It's very confusing. The internet is just too full of help from experts, and it's very confusing. It's very difficult to tell the real experts from the pretend ones. And also the chart packaging themselves are overwhelmingly comprehensive technical analysis, much too much technical analysis. I would focus on the following. Keep the number of indicators that you use to as few as possible. You want to avoid overcomplicating and duplicating any message. Getting two ways of measuring momentum doesn't mean you'll measure it better. Momentum is momentum. And the strength of the trend is the strength of the trend. Two different methods only make it more difficult to understand. Learn the indicators, find the one that suits you best. What you want to measure is the strength of the trend using perhaps the ADX, average direction index, to do that. The direction of the trend using some moving average based technical analysis. For example, the MACD, moving average convergence divergence. So you've got the direction of the trend, let's say up, and the trend is strong. The ADX is above a certain reading. Then you know that markets move. If you're an investor, that's the right side you want to be on. Things are going up strongly. Is basically what you want to own. And if you're owning things which are even flat, you're basically tying your money up in things which aren't creating a capital gain. So you might pull the money out of that and put it into something else which meets that criteria. Very simple criteria. Then the next one is that, let's say you're more of a trader. And so inside that trend, you know that we don't move in straight lines. We go zigzagging our way up, for example. So the zigs we call impulsive moves because they're in the direction of the trend. The zags we call reactive moves. And we measure that. And a good way of measuring that is the relative strength index, Wells-Wilder's relative strength index, which is an oscillator. And this gives you a reading inside the trend itself of how excessively you've moved in the direction of the trend, or whether there's potentially a dip to buy in the trend. And I would use also a way of analyzing the volume, like on-balance volume, to add that extra dimension. The volume is like the fuel, the power of a market. It will only go up if people buy it. Are they buying it? You can see that data clearly in the volume. If the market's going up and the people become more reluctant to buy it, it's potentially a toppy area. So that's all you need to know, really, about a market in terms of that drop down of indicators. I would also put on the 50 and the 200-day moving average because so many people pay attention to that. And maybe there is some self-fulfillment in that. But to me, by the time the 50 crosses down through the 200, I would definitely want to already be short of that. That's a long time after the top that you get that message. Learn charting. Charting is great. And this is something where, as a private investor, you're at no disadvantage to the institutional trader. They haven't got the time to do it. You're actually at an advantage to them in this case. And so learn to be a good chartist, trend line drawing accurately, trend line breaks, understanding when a good break versus a false break, chart patterns, head and shoulders, triangles, double tops and bottoms. Learn these things and learn how to put them together, and then ultimately become as systematic, as rule-based as possible in terms of your risk and reward and your plan for the trade. So the trading itself becomes a process. And so you're not doing any thinking while you're in a position. All the thinking was done before the position itself. And so it's like playing chess, where you're trying to think ahead. It's more difficult than chess because there are only two players in a chess game. There's more than two players in the market. But basically, everything that happens, basically you already thought of your response. That in a few seconds is my distilled course in technical analysis.
That is fantastic. Thank you very much indeed. So, just to summarize, anyone sort of interested in having a closer look at what you're doing can go to CMC Markets, find out more about those baskets that they've already launched and already available to their clients. And also in terms of the any companies or fund managers who have listened to this podcast, they can go to relativerotationgraphs.com, which is your RRG research site, and where there's more information on what you're up to there.
Yes, that's exactly right. So the CMC, then search for RRG in the search box, and then you'll come to the funds that we've got on offer, and you'll see the performance there and whether we've managed to achieve what we're trying to achieve. Go to the S&P one, it's the best one if you want to start with the best one at the moment. And then relativerotationgraphs.com, as Stuart said, sorry about it, it's a bit of a mouthful, but it's relativerotationgraphs.com, and there you will see sample ones, live ones of currencies, cryptocurrencies, a couple of indices. They're samples of them, and you can move about those charts and change the sample period and zoom in and out. So they're simple versions of it, not the Bloomberg version. But there is also quite a lot of research on that, about that we did when we were developing RRG, which is the right period to use to get the maximum persistency of the message of outperformance and so forth. So we've done some papers looking at what it shows, moving towards the rule-based quantitative approach, which we're using for the CMC CFD products, the Momentum Plus products.
Fantastic. Well, thank you very much indeed, Trevor, for coming on the podcast today.
It's been my pleasure, Stuart. Thank you very much.
You've been listening to the Armchair Trader podcast. To get up-to-date commentary on what's happening in the share markets, both in Europe and North America, and our views on some of the emerging investment stories in the small cap space, make sure you check out www.thearmchairtrader.com and sign up to our free daily newsletter.